hold on a second, I'll put it up. Will I put it up a time frame or not? Let me just change this around a little bit. Okay, so this is what I'm trying to show here, is that there's different types of phases that the market has in it. There's the sell-off phase, there's the momentum phase, there's the BSG into a commercial phase, there's the pullback phase. There's a lot of different phases that people get confused about when they look at the markets. And you can see, for example, here, there's a lot of momentum sellers, but there's also BSG squeezes that come from top lines. So you can see that we move from a BSG buy phase with a failed auction at the top edge up here. And I've taken off all the commercial activity. So this is all the prop stuff, right? This is just pure prop. Everybody should obviously understand the difference. Pure prop will never be buying bottom edges, will never be selling top edges. That's commercial's domain, right? So this is pure prop trading. So all of these are trades that are going to be traded by the prop desks. So you can see that we move from a buy phase here into a sell phase here, a BSG sell, a momentum sell here, a momentum sell here, and a momentum sell here. You can see these are all selling opportunities. You can see that we get a momentum and a BSG sell in this area here, and that kind of lines up with the bottom edge. Now we get a little bit of a phase here. Look. We've got momentum sells, but we've got squeezes, BSG squeezes. We start to see that we're in a two-way money market phase. Now, isn't that interesting that at that stage, the price ends up going into a two-way money market phase? The price doesn't move during that period. It kind of sticks around, and it doesn't go anywhere. Now, obviously, if the market were to break out, the sales would vanish. There is no prop selling. The algorithms would switch off. The trades that would disappear. And you can see that as the price didn't break north but broke south, we now go back into BSG selling. We now go back into momentum selling. The props are now back short after the market failed during this little phase here. So after the market failed there, the props start selling back into this, and we start selling on pullbacks. We start selling on pullbacks. We sell more on pullbacks here. You can see these BSG squeezes here. You can see BSG and momentum selling coming in here. We can see that there's another BSG squeeze here. And you can see that this BSG squeezing becomes very, very, very exciting. Now, bearing in mind, BSG squeezing is trading against some bottom edge buyers. That's the difference between momentum and not. If we've got a momentum sell, there hasn't been any detection that there's a bottom edge buyer in place. But if we've got a BSG squeeze, it's squeezing buyers, right? That's what you squeeze. You're squeezing longs. So there was obviously some longs, probably one would imagine, coming in off of this kind of area here. So you can obviously imagine that there has been longs trying to hold this price in place. And that's why we get BSG squeezes through this phase. And then we change to momentum selling through this phase here. We get momentum selling short here. Momentum selling short here. We start to recognize that momentum short. We then see the BSG squeeze coming back in again, and we get another sell. And we can see that the momentum shorts coming in up here. We get the BSG squeezes coming in here. We get the momentum short here, and we get another BSG squeeze here. And you can see that through that process, we start to recognize quite a significant achievement by the sellers. Quite a significant achievement by the sellers through that phase. Lots of shorts, lots of opportunities to get short, and obviously this is something that you start looking for, isn't it? It's what phase of the market are we in? So when you look at the various phases, you might start to recognize patterns. Well, I would hope you're going to start recognizing patterns by simply observing colors. You see colors, yeah. Let me just show you, if you zoom out a little bit, and you can start recognizing the color array that you start to see on the screens. Let's see if you can spot let's see if you can spot whether the market's bullish or bearish. Well, of course you can spot when it's bullish or bearish, can't you? It's not exactly hidden from anybody's view. You can see there's a very, very bullish phase here. And you can see that that changes dramatically into a very bearish phase here with lots and lots and lots of squeezing to the bottom edges. A two-way money phase by the looks of it, a little bit in here, but predominantly still selling. Changes to a bullish phase here, and then a little bit of two-way money again, starts to sell off here. A little bit of a buy phase here, and then obviously the momentum sell phase there, and then a little buy phase just there. That's obviously before today's big sell-off. That was from last week. And it's basically just showing you that, you know, trading with momentum is a very, very good play, right? I mean, that's the interns exercise, right? If we understand the interns exercise, that trading with momentum is part and parcel of this journey, is part and parcel of this process, we can start to maybe recognize the value of trading the way we're dealing, the way we're showing you this, a little bit of business here. You can start to recognize that sticking with the momentum trades, especially when the volatility is really ramping up, is probably a good idea. When volatility is increasing, you want to go with momentum. If volatility is reducing, you want to go with fades, because when volatility reduces, there's a reason. That reason is, of course, commercial buyers, commercial operators acting on the bottom edge prints or the top edge prints. So we can start to recognize that momentum shifting. Now you might be saying, but surely in a bad market that this type of idea here is going to lose you a lot of money. Well, it depends how you trade, of course. You're going to get buys getting pressed, you're going to get sells getting pressed, but you know, this is the basis of the turtle though, isn't it? This is the kind of concept of turtle trading when you think about what a turtle does. When the turtles trade, of course, they trade only one side. And as soon as they get a sell coming in, they chop that side off and they start selling it. And then the turtles sell off behind that move. And obviously that's what they do. They try and run the big swings. They try and run the big narratives. And they're obviously trying to be short when the market breaks south, and they're trying to be long when the market breaks north. It's not a bad idea, except when the market doesn't break north or south. And that's something that we can start to recognize with the addition of something as simple as value, of course. If we can start recognizing that value is against us or with us, we can start to recognize some brilliant trades.